Good evening, everyone. Time for another member update. Now, this is the Dow Industrial Average crossed over the silver spot chart monthly, provided by netdania.com. You can click on the link below. Now, these are not highly correlated markets. The beta is not that strong. You can see a period in here when it was, and the general trend may correlate. You can see by the general trend line. Certainly in this area here, they were fairly tightly correlated. You can see the breakout there of the stock market going up and silver going down, moving in opposite directions for a significant period of time. Now, just recently with the downdraft in the stock market, we can see that they seem to be now fairly highly correlated. That's a recent phenomenon. And we do tend to see silver go down with stocks in deflationary scare sort of scenarios. So that's what we're seeing now. We're seeing stocks fall. We're seeing silver fall. Silver's actually down to about $19 now. And you can see that the chart that I've been pointing out for some time is the spike top MACD sell signal, this one here. And you can see, so that one is confirmed now. That sell signal is valid for these two. Again, this long-term uptrend is still intact. It's going to take a breakdown. Well, you can draw the trend line in different ways. If we draw it loosely, it's going to take a breakdown through 1725 or 18 to break this uptrend. So it's by no means over yet, but this is bearish in the short term that we have confirmation of these sell signals on the MACD. So what we're going to be talking about tonight is trade, balance of trade, dumping, and ultimately we're going to try to connect that to silver and dumping silver. But let's start out with this Zero Hedge article. Now, this is a sticky topic, and it's one that doesn't break down easily between conservatives and liberals traditionally, economically, because of people like Donald Trump, who's a sort of a populist candidate right now, coming in on the side, probably on the side of tariffs, talking about China being a trade manipulator. Now, let's read the Zero Hedge article and keep in mind, whether these things are actually true. I don't agree with them. I am a free market person. I'm going to try to explain to you why this issue is so confusing and why tariffs really don't work in the long run. True, what we have is not free trade, but what China is being accused of here doesn't make sense on its face, and we'll dig into that. So this is exposing how China cheats on trade in the aluminum industry. Since entering the presidential race last year, Trump has made international trade a cornerstone of his campaign and has promised to go after countries like China that cheat on trade, quote. In fact, the Trump website promises that day one, his administration will take steps to designate China as a currency manipulator and crack down on illegal export subsidies that intentionally distort international trade. On day one of the Trump administration, the U.S. Treasury Department will designate China as a currency manipulator. This will begin a process that imposes appropriate countervailing duties on artificially cheap Chinese products, defends U.S. manufacturers and workers, and revitalizes job growth in America. We must stand up to China's blackmail and reject corporate America's manipulation of our politicians. The U.S. Treasury's designation of China as a currency manipulator will force China to negotiate to the negotiating table and open the door to a fair and far better trading relationship. China's illegal export subsidies intentionally distorts international trade and damages other countries' exports by giving Chinese companies an unfair advantage. From textile and steel mills in the Carolinas to the Gulf Coast shrimp and fish industries to the Midwest manufacturing belt and California's agribusiness, China's disregard for WTO rules hurt every corner of America. As we've noted in the past, the aluminum industry provides a textbook example of how China cheats on trade and the corresponding impact on U.S. companies. In fact, the Wall Street Journal recently took a look into the production and trading activities of one of Chinese aluminum producer, China Zhongwang Holdings Limited, that seemingly cheats in many of the ways Trump enumerates above. As background, China is the biggest producer of aluminum in the world, with production fueled by access to inexpensive electricity and tax breaks from the government. As local demand plummeted in the wake of the Great Recession, much of China's aluminum production has found its way to the U.S., though often not through direct or technically legal channels. The dumping, now keep this term in mind here, we're going to explore this term. The dumping of cheap aluminum on U.S. market has decimated domestic production, with only 5 aluminum smelters left in the U.S., down from 23 in 2000. In fact, Alcoa, the largest American aluminum maker, recently announced plans to spin off its aluminum production assets in order to isolate its more profitable parts-making unit. Alcoa CEO Klaus Kleinfeld attributed the move to illegitimate Chinese exports that were the major driver of lower aluminum prices. So we have these words here, illegitimate Chinese exports, dumping, but what do these words really mean? We're going to see in a minute here, but I want you to look at this chart. Now keep this chart in mind when we talk about dumping, because when we talk about dumping, it's mixed up with economic practices that occurred during the 19th and 20th centuries, where in America, Canada, Britain, you had large cartels, and their policy was to drive others out of business. And so the big question is going to be here, is this really dumping? And what's the motive for dumping? You can see here that this increase in annual aluminum production by China has increased steadily over the years from 2009. Now, keep this in the back of your mind here, that if it's assumed that dumping is an selling intentionally at a loss, that's what they're implying. That is the moral view of it, that it is immoral to sell at a loss for the purpose of driving your competition out of business. And the first question I'm going to ask is, how reasonable is it to assume that a company or a country or anyone is going to spend 1, 2, 3, 4, 5, 6, 7, and we're probably in this 8th year, 8 years in a row operating at a loss? For what purpose? That doesn't make a lot of sense. Now keep in mind this statement here about electrical costs. Are electrical costs, here it is, inexpensive electricity. Are electrical costs in a country an unfair advantage? And what is competition? If a country is able to produce electricity cheaper, should it not be able to compete better? And isn't that the purpose of trade? So this is a very confusing topic, and there's a lot of politics involved. So let's continue. Back in 2009, U.S. aluminum imports from China surged, causing import prices to plunge by 30% and crushing U.S. producers like Alcoa. That surge in imports and simultaneous price collapse caused the Commerce Department to take notice. In 2010, the Commerce Department enacted new tariffs on Chinese aluminum imports after an investigation revealed that the Chinese were dumping cut-rate aluminum on the U.S. markets while receiving subsidies back home. But the story doesn't end there, of course, as the rabbit hole goes much deeper. Unable to dump aluminum in the U.S. market directly, Zhongwang Holdings, a large Chinese aluminum producer, found a workaround that involves rerouting U.S.-bound aluminum through Mexico. In fact, a review of trade data found that just as China's export of aluminum to the U.S. collapsed in 2010, they simultaneously surged to Mexico. Jeff Henderson, president of U.S. trade group known as the Aluminum Extruders Council, took note of the shift in Chinese exports to Mexico and decided to dig a little deeper. As such, he commissioned a plane to fly over a small factory in Mexico and, to his great shock, found about 6% of the entire world's inventory of aluminum sitting in the middle of the Mexican desert covered in tarps. 2 years ago, a California aluminum executive commissioned a pilot to fly over the Mexican town of San Jose Iturbide at the foot of Sierra Gorda Mountains and snap aerial photos of a remote desert factory. He made a startling discovery. Nearly 1 million metric tons of aluminum sat neatly stacked behind a fortress of barbed wire fences. The stockpile worth some $2 billion and representing roughly 6% of the world's total inventory, enough to churn out 2.2 million Ford F-150s or 77 billion beer cans, quickly became an obsession for the U.S. aluminum industry. Aluminum industry representative Jeff Henderson says he's convinced that China's Zhonghuang Holdings Limited, a Chinese aluminum giant controlled by billionaire Liu Zhongtian, tried to evade U.S. tariffs by routing aluminum through Mexico to disguise its origins, a tactic known as transshipping. Now, I want you to note here that this is controlled by billionaire Liu Zhongtian. How does one become a billionaire? By selling things at a loss. Something's not adding up here. Of course, Liu Zhongtian, owner of Zhonghuang Holdings, denies any effort to avoid U.S. tariffs by shipping through Mexico, and it goes on to do an expose of that. Now, the big question is going to be, is this dumping? And even bigger question than that is, what is dumping? So let's take a look at the Wikipedia entry under dumping pricing policy. In economics, dumping is a kind of predatory pricing, especially in the context of international trade. It occurs when manufacturers export a product to another country at prices either below the price charged in its home market or below its cost of production. Okay, so those are the two definitions. Now, we're going to find out here with China as we read below this that China doesn't really have a true home market according to the WTO. So the question is China really selling its aluminum below the cost of production? And is China really selling everything below cost of production? Let's keep this chart in mind. This is Wikipedia's list of countries by current account balance. You can see for the year of 2015, China had a $293 billion current account surplus. This is the list of countries, 20 countries with the largest current account surpluses. China comes in at the top with $293 billion, followed by Germany, Japan, South Korea, the Netherlands, Taiwan. Down below are the 20 countries with the largest current account deficits. And you can see the United States comes in at $484 billion, followed by the United Kingdom, Brazil, Australia, Canada. So I want you to keep this in mind. Now, it's pretty much based on common sense that being at the top of this list is a good thing. Being at the top of this list is a very bad thing. I also want you to note that although China has a $293 billion surplus, the United States has a $484 billion deficit. So 1.5 times larger deficit. Just on the face of it here, it would appear that the problem is not China, but the problem is the United States, the policies of the United States. So keep this in mind, that someone's going to make the contention that a country is operating below its cost of production. This we're talking about in the case of aluminum, but virtually everything now, manufactured goods, raw materials, rare earth metals, they come from China. And are we to believe that China is operating below its cost of production? That would mean that it's making a continuous loss. That would mean that they would be shrinking economically. Something is not adding up with this explanation. So let's continue. The purpose of this act is sometimes to increase market share in a foreign market or to drive out competition. Now we're going to get to a comment from an article in The Economist. This is called Dumping and Tub Thumping. And this gets a little bit more clear about the purpose of dumping. And it says here, dumping is the practice of selling goods in foreign markets at an unfairly low price. Now, people who are free market people, people who are von Mises school type people, generally believe in free markets, believe in unfettered markets and competition, would tend to bristle at a phrase like unfairly low price. What's an unfairly low price? Now, if we're going to admit that I think probably the company that's been accused of this the most in the U.S. would be Walmart, that they've driven others out of business. And the question is, does Walmart come in, drive everybody out of business, and then raise their prices? And that's going to be a key contention with this dumping idea, because it has to be, if this is truly a strategy that is being used by a company or a country to put their competitors out of business, then they're obviously going to have to raise prices in the future. And that's what this implies here. Dumping is the practice of selling goods in foreign markets at an unfairly low price, typically one lower than the going rate in the exporter's home market. Anti-dumping measures are intended to prevent a company from selling goods below cost in order to drive competitors out of business before using the resulting market power to gouge customers. Okay, so you can see from that explanation that the only reason why you would pursue a policy of dumping as a strategic economic plan would be to drive them out of business, so ultimately you can raise prices higher than you would have been able to raise them if they were still in business competing with you. So keep that in mind. Now, this goes into the WTO and their rules about dumping. It's interesting that what they say about China is not applicable to their definitions of dumping. We're going to read this here in the section here about China. And here's the Chinese economic situation. The dumping investigation essentially compares domestic prices of the accused dumping nation with prices of the imported product on the European market. However, several rules are applied to the data before the dumping margin is calculated. Most contentious is the concept of analog market. Some exporting nations are not granted market economy status by the EU. China is a prime example because its market status is considered state-sponsored capitalism. In such cases, the DG trade is prevented from using domestic prices as a fair measure of the domestic price. A particular export industry may also lose market status if the DG trade concludes that this industry receives government assistance. Other tests applied include the application of international accounting standards and bankruptcy laws. The consequences of not being granted market economy status have a big impact on the investigation. For example, if China is accused of dumping widgets, the basic approach is to consider the price of widgets in China against the price of Chinese widgets in Europe. But China does not have a market economy status, so Chinese domestic prices cannot be used as the reference. Instead, the DG trade must decide upon an analog market, a market which does have market economy status and which is similar enough to China. Brazil and Mexico have been used, but the United States is a popular analog market. In this case, the price of widgets in the United States is regarded as a substitute for the price of widgets in China. This process of choosing an analog market is subject to the influence of the complainant, which has led to some criticism that it is an inherent bias in the process. However, China has one of the world's cheapest labor costs. Criticisms have argued that it's quite unreasonable to compare China's goods price to the United States as analog. China is now developing a more free and open market, unlike its planned economy of the early 1960s. The market in China is more willing to embrace the global competition. It is thus required to improve its market regulations and conquer the free trade barriers to improve the situation and produce a properly judged pricing level to assess the dumping behavior. So you can see there that based on the definition, they don't really even have a way of assessing whether China is dumping or not. And again, this is assuming that this whole concept of dumping is valid, which I contend is not. That if in fact dumping was something that was done on a regular basis, either by a company or by a country, and it was done on a continual basis, then it would lead to bankruptcy. So obviously, in my opinion, that's not what is happening. Now, I want to read you this comment about the aluminum market that's a little bit more enlightening than the zero hedge. And this is from that Economist article, and a reader commenting saying, a similar situation is occurring in the aluminum industry, not just primary aluminum, i.e. from smelters, but also in value-added flat-rolled products, or FRP. Despite being a long-life supporter of free trade, I have concluded that trade with China, at least in FRP aluminum, is anything but fair. Part of the equation on which free trade is based is that advantage should flow to those producers with an inherent advantage. Now, we've already talked about how low electricity costs are in China. We've also talked about how low labor costs are in China. If you have better input costs, more efficient equipment, better technology, or I might want to add lower tax burdens and less of a welfare state and less of an intrusive government regulatory agency, are those things that should be considered as well, etc., then you can charge a lower price, gain market share, and make higher profits. If you don't have these advantages, you typically lose share, profits decline, and or business runs out of cash. Eventually, the least competitive producers exit the business. For free trade to work properly, all producers need to be exposed to these forces. However, these dynamics do not exist or are heavily retarded in China. For years, China has been boosting its GDP by investing in large, capital-intensive projects regardless of demand. Hence the growth of their industrial manufacturing base, since simply constructing these mega plants itself boosts GDP. The government became a type of super venture capitalist, which allowed many businesses that would not have otherwise justified this amount of investment to spring forth, often with an advantage in technology, with no expectation of proper return on investment. This result has been dramatic amounts of overcapacity in China, all of it looking for a home in other markets. Once built, these plants are not managed by typical metrics that we recognize in the West: profitability, cash flow, return on investment. Instead, these businesses are managed with a focus on boosting national GDP and maximizing employment. Well, that's kind of interesting, because isn't boosting GDP and maximizing employment the very thing that the people in the West are proposing that we have tariffs for our industries to do? So we're criticizing China for implementing policies that boost their GDP and maximize employment, but we're wanting to do those very policies here, and something's not adding up. In other words, plants keep shipping volume regardless of the profitability of the business. Favorable loans are made or terms are extended to ensure the plants keep operating regardless of whether the underlying fundamentals of the business even remotely justify such credit. In short, inefficient or financially unattractive producers do not exit the market as would be expected. In the FRP aluminum market, the Chinese players have a further artificial advantage. While most of the world's FRP producers purchase their aluminum at the price established by the London Metals Exchange, the Chinese competitors have access to a separate exchange, the Shanghai Futures Exchange. The Shanghai Futures and LME price are not well correlated. The Shanghai Futures Exchange price has been lower than the LME price for extended periods over the last 5 years. While the Shanghai Futures Exchange price has occasionally risen above the LME, the dollar per ton advantage of the LME is decidedly smaller than the advantage of the Shanghai Futures Exchange often enjoys, and the periods of LME price advantage are much shorter in duration. A final advantage of the Chinese FRP producers is that several of them are owned, at least indirectly, by the Chinese government. Faced with this type of competition and China's sometimes arbitrary property and investment laws, few foreign competitors are willing to invest into the market. Facing these types of hurdles, it is little wonder that Western companies are seeking relief from some form of tariff. Who can blame them? So there's an interesting perspective on the aluminum market. Again, though, the same question comes up. if the Chinese companies are continuously operating at a loss while increasing their share of the aluminum market, and the government is operating at a loss because it is using tax money, tax revenues to support these inefficient industries, then why is it that China has this gigantic current account surplus? The United States has a current account deficit, and the share is growing. It doesn't make sense. It doesn't add up. So what's behind this? Well, I'm going to explain that in a second, but I wanted to take you to the Kitco spot aluminum chart. Now, this is interesting because he mentioned the 5-year Kitco, 5-year LME. This is the Kitco LME chart. He mentioned the 5-year LME prices, and you can see here's the 5-year aluminum spot according to Kitco. You can see we're plumbing the depths. We're not at the lowest point we've been, but prices are down significantly. But even more shocking than that is the 5-year aluminum warehouse stock level. So you can see that from a high of 55, we're all the way down to nearly 20. So almost down 2/3 the warehouse stocks, going all the way back to 2011. We don't know how far back this goes, but it's a really bad situation. So as we've got aluminum piling up in Mexico, it is disappearing from the London Metals Exchange, perhaps because the price is so much higher, people are selling it off. I don't know, but a question comes up, why isn't there arbitrage between the LME and the Shanghai Metals Exchange? Should China being able to get their aluminum cheaper to create their FRP and sell it abroad, is that an unfair advantage? So based on all those things, I would have to say that this is a fraudulent, a bogus argument. To say that China cheats on trade, that's the typical complaint of a sore loser. I don't agree with the system that China has. I think China would be better served by having free markets. But then again, China's best state-run capitalism, if you want to call it that, their worst is better than our best. We are so terrible as far as regulations, and I've mentioned rare earth metals before. I think China produces around 95% of the rare earths now, and someone had talked about how, well, that's because China has an unfair advantage. Well, no, China doesn't have an unfair advantage at all. China is just simply willing to mine them and deal with the environmental costs, and China has the low-cost inputs to do that. That's why China controls 95% of rare earth market. Actually, the abundance of rare earth metals are very, very high in the United States. The United States, for many, many years, was the biggest producer. So again, same argument. It's not that China's cheating. It's not that China has an unfair advantage. It's not that China's government is helping them, although where do you draw that line? A government that doesn't overtax you, overregulate you, provides cheap power, cheap resources, is that an unfair advantage? It's stupid to quibble about those things. The bottom line is that China is kicking our butt in trade. There's no getting around that. And what we need to do is improve. And coming in and adding a bunch of tariffs isn't going to fix that. Right now, the United States, from one of the articles I read, only imports 3% of that aluminum. So 97% of that is with the rest of the world. And that was demonstrated also as well on the current account balance. You can see that China is doing stuff with the rest of the world, and the United States is not only going into debt to China, but going into debt to all the rest of the world. So the problem is not China. The problem is the United States. And what they're proposing isn't going to be a fix. Now, let's take this over to silver, and I want to apply this. So if what is happening in China is not accurately described by the term dumping, then what is happening? Well, one could say that there is a gigantic conspiracy, maybe a century old or decades old conspiracy, where China is dumping everything and they're willing to take losses for many, many years or even decades so that they can ultimately torpedo and sink the United States. That argument, that's a hard argument to make because they have that trade balance with the rest of the world as well. Are they trying to sink the whole world? Is China committing economic suicide so they can sink the economies of the entire world and have all manufacturing and all agriculture and all mining in China and everybody else buy from them? That's a pretty big conspiracy, even for conspiracy theorists. So if we're talking about silver, what is happening with silver? Is silver being dumped? And if there's dumping going on, who's doing the dumping? Is there a particular country that's trying to put another country out of business? We know that the United States is going down in the list of silver producers, even as the coin purchases rise. So the question would be, if silver is being dumped, who is doing the dumping and why? We've already talked about the fact that the whole purpose of dumping is to sell at an artificial price up until the point you drive your competition out of business, and then raise the price high enough to make up for the loss that you took and to be able to gouge in the future. Is that what's happening in silver? And what does that portend? Does that mean when they've driven all the silver miners out of business, then they're going to gouge and drive the price of silver absolutely through the roof? Perhaps. Maybe they are dumping silver. And we'll talk to you next time.